Welcome everybody to lecture video 1 of chapter 4. So what we're going to be doing in this video today is just giving you a little bit of a recap and review of any income statement information you may have learned from your financial accounting course. The goal of this video is basically just to bring everybody up to the same level, get everyone on the same playing field so that when we explore new concepts and new ideas in the later lecture videos, we'll all have the same general foundation and basis of knowledge to draw off of. So it's going to help make those other videos a lot more smoother and a lot more easier for you guys to understand. So I'm going to split this video up into 3 parts. First part, we're going to be talking about, what is the purpose of an income statement? Why do we make it? What is the point? And we're just going to go over a basic example of an income statement. Second part of the video, just going to be talking about this term, quality of earnings. We'll explore it more when we get to it. And the last part of the video is going to be differentiating, what is operating revenue and expenses versus what is non-operating revenue and expenses. Now, you may be wondering, why we're going to look at that, but I promise it'll come into play later, and I'll explain a bit more in detail once we get to it, okay? But for now, what we're focusing on is what is an income statement and how to prepare a basic one, okay? So, what is an income statement? What is the point of preparing this thing? And so what the main goal of the income statement is just to showcase net income. Now, I'm sure most of you know what net income is. Net income equals revenues minus expenses. You basically take all the money, right, that you've incurred, all your revenue, right, all the money you've made throughout the year from your company, and subtract it from everything you've spent in order to make that money. So all your expenses, right? And that gives you net income. Net income basically means profit. But us accountants, we like to complicate things, give things weird names, so we call it net income rather than profit. But it basically means profit, okay? For those who don't know. All right, so the main goal of the income statement, right, is just to showcase all the work, needed in order to arrive at this net income figure. So you're going to showcase all your revenues. Goal is to add up all your revenues and then just to subtract all your expenses, like the calculation says. Net income equals revenues minus expenses, right? And then you finally show your net income at the bottom of the statement. So that is the general layout and the gist of it, right? So companies do this because they want to show the profitability of the company. Because all these statements that we prepare, like the balance sheet and stuff, they're for shareholders. We want other people from the outside to look at these statements and say, you know what? This is an awesome company. I think I'm going to give them my money and invest in them because they can do some great things. But, the best way to persuade them is to show them your financial information, right? And one of the best statements to show people to get them to invest is the income statement. If your business is making a lot of money, then, people from the outside are going to look at these statements, look at the net income, wow, this company's doing great, I'm going to give them money, I'm going to invest in them, right? So that's why this statement is so important. So now that you know what the point of the income statement is, what we're preparing it for, who the income statement's for, and what it's supposed to showcase, now we can begin to look at, how do you prepare a basic income statement, right? How do you do it? So this right here is an example of one, right? And now we're going to go through and discuss how exactly you start from nothing to arrive at this statement. Okay, so in order to prepare this statement right here on the screen, it's going to take just 5 steps, 5 basic steps. So the first step is to start with your header. And you do the same thing for all the statements. You've probably done it so many times before in your other accounting classes. You always start with that header. Okay, so you always start with the company name, the statement kind, in this case, it's an income statement. And then lastly, put in the date that the income statement was made for, right? Simple header, that's all it is. Nothing new, nothing complicated there at all, right? But I only mention it because, some professors might dock marks if you don't do it. I know some did in financial accounting, so just want to reiterate that in case that may be the case for your prof. So the second part of the income statement is to list and fill out your revenue section. Okay, we always do revenues first. So in the revenue section, there are 2 things we do. First thing is we calculate this thing called net sales. And then secondly, we just list out the rest of our revenue accounts. Okay? So what is net sales? Net sales equals sales minus sales returns and allowances minus sales discounts. Okay? Basically, sales returns and allowances and sales discounts, it offsets sales, right? If we sell, $1 million worth of merchandise to someone and to a certain customer, and they return $100,000 worth of that merchandise, well, we only had net sales of $900,000 then, right? Because we do $1 million minus the $100,000 that they returned, okay? Because we didn't actually sell $10 million in that case, since some of it got returned. So we would like to record that first, okay? So as you can see on this income statement, right, we had sales of $14,200. However, throughout the year, about $2,200 of those sales were returned. Okay, so we arrive at a net sales figure of $12,000. So we record that first in the revenue section. Then the next part is just to list out the rest of our revenue accounts that we incurred throughout the year. But as you can see on the statement, we've only incurred one other kind of revenue this year: dividend income. Now, dividend income is going to be a term that you're going to hear a lot, and you're going to see it a lot throughout this chapter. So I'm going to take a moment here just to explain what dividend income is, so you can better understand what these statements represent. Okay? So a dividend is basically a payment that a company will make to their shareholders, for holding their shares. It's almost like an incentive. So now let's take a look at how this dividend income of $2,300 that is reported on our income statement was actually calculated. Just so that you guys can get, a real life example of how dividend income is calculated and then reported onto the income statement. Okay, so as you can see from the header here, we are the Sarwar Corporation. Now, let's say, we as the Sarwar Corporation decide to invest in the Ali Corporation. So at the beginning of the year, we buy 23,000 shares of the Ali Corporation. And let's say at the end of the year, the Ali Corporation, decides to thank all their shareholders by issuing a dividend of 10 cents per share held. So therefore, we bought 23,000 shares at the beginning of the year, and we were receiving 10 cents per share of a dividend. Therefore, our total dividend income is simply 23,000, right? The number of shares multiplied by the rate, which is 10 cents per share. 23,000 times by 10 cents equals $2,300 of dividend income. So this finishes off our revenue section. So then all we got to do now to calculate total revenues is just take, our net sales of $12,000, add that to our dividend income of $2,300 to arrive at our total revenues of $14,300. So the next step is to list and add up all of your expense accounts. Okay, we add up all of our expense accounts except for income tax. Okay, income tax is the only exception here, and it's a rather special case. We just like to showcase it later on in the statement and isolate it, right? For whatever reason, this is just how shareholders prefer to read the statements. So just know that we record all of our expenses in the expense section except for income tax. Okay. As you can see on the statement here, I have formatted it whereby I list all the selling expenses, add them up for total selling expenses, and then I list and add up all the administrative expenses. Now, this is just the way I formatted it. I don't want you to worry about the formatting at all right now. We're going to explain that in the second lecture video, but just know that for this section here, we just list all of our expenses and add them up except for income tax. Okay? So in this case, we have sales office salaries of $2,000, advertising expense of $1,100, office salaries of $1,500, and insurance expense of $250. If we add up all those, we get total expenses of $4,850. So the next step then is to calculate your income tax. Okay, remember how I said we isolate it? So this is where we isolate it. So first, what we're going to do is we're going to calculate what is called our net income before tax, which is simply our total revenues minus our total expenses, right? Except for income taxes in there, hence why it's net income, but before tax. Okay, so our total revenues in this case, $14,300, and our total expenses are $4,850. So $14,300 minus by $4,850 gives us our net income before tax of $9,450. After we've found our net income before tax, we can simply calculate our income tax expense. All we got to do is take our tax rate and multiply it by net income before tax. So our tax rate, as we can see on the statement, is 20%. So we just take 20% and times it by net income before tax, which is $9,450, giving us a income tax of $1,890. So the final step here is just to calculate net income. And all we have to do that is just take our net income before tax and subtract by our income tax expense. Very, very straightforward and simple. So we just take our net income before tax, which is $9,450, subtracted by our income tax, which is $1,890, and we arrive at our net income of $7,560. And that's basically how you do a basic income statement. Now, you'll probably never have to prepare anything this small on a midterm exam, but it is important for you to gain this understanding and foundation of how to prepare it in order for you to be able to prepare harder, more complicated questions. So I recommend that if there are a few things you didn't understand, you go back and rewatch because it's going to be very important for you to know how to prepare this going forward. So now we're going to be moving on to the second section of the first lecture video. As I mentioned at the beginning, we're going to be talking about this term, quality of earnings. Okay? A lot of you probably wondering, what is quality of earnings? Why are we looking at it, right? And I'll be honest, it's a little bit of theory, okay? A lot of you probably don't really care. You know, probably Thomas. You're probably saying, Thomas, you know, we just want to know how to prepare this stuff so we can do well on the exam. Well, listen, I know, right? And while the exam's going to have a lot of application questions on it, you know, they also sometimes incorporate a little bit of theory questions too. And I've seen them, you know, throw in questions regarding quality of earnings. So that's why I'm bringing it up right now, and I want to touch on it for a moment because I think it's important for your success on the midterm, as there could be a question on it. Okay? So just hear me out for a little bit. So quality of earnings, what is it? Quality of earnings just basically means how much value does the information on the income statement provide users? How useful is a company's income statement? So if an income statement is very useful to a shareholder or to a stakeholder, then that income statement is said to have high quality of earnings. Okay, the value of the information presented on this thing is very high. Okay, that's what it means. And obviously it's important for companies to have higher quality of earnings because the more useful a company's income statement, you know, the more likely shareholders are going to actually be able, or stakeholders are actually going to be able to look at it and make a decision whether or not to invest. Because honestly, if a stakeholder looks at, you know, a random company's income statement and it looks terrible, they can't understand a word that's written on it, they're not going to invest at all. And that company's going to have lower quality of earnings. Whereas the income statement was nice and clean, easy to see, easy to understand, investors could be more inclined to throw their money towards this kind of organization. So that's why it's important. Okay? That's what it is. Now there are two criteria that makes up, you know, higher quality of earnings. What are these two criteria? Content and presentation. Okay? So let's look at content first. There are two components to content. All right? So the first one is the integrity of the information. What this means is the information presented on the income statement, is it free of bias? Okay, so this one's a no-brainer, right? Obviously, if an income statement is presented and it's like has a bunch of, like, you know, there's fraud on there, you know, there's unethical reporting, how are you ever going to trust it? How is that income statement providing any value? You have no idea what they're writing on there. You don't know what's true or what's not. So obviously, you'd have a lower quality of earnings. So quality of earnings, right, under content, you need integrity. Your information needs to be free of bias. The other component of content is the sustainability of earnings. Okay, and what this means is that when a user looks at your income statement, they should be able to not only see what the net income is of this year, but they should be able to use that information to predict how the company is going to do 1 year, 5 year, 10 years from now, right? They got to be able to predict how the company will do based on the income statement. Obviously, if a stakeholder is looking at an income statement and he can see, oh, the company is going to do very well in 5 years, I can see that, then he's going to be more inclined to invest, thus higher quality of earnings. And that basically sums up content. So, second criteria, presentation. Presentation just needs to be clean, nice, and organized. All right? Not everyone looking at these statements are accountants, right? They're usually just, investors that come from a variety of backgrounds. So, if companies are writing their income statement with a bunch of jargon, how the heck is a stakeholder or a random guy on the streets going to look at this thing, or investor look at the income statement and understand what the company's talking about? They won't, and so they won't invest. So it's got to be clear, it's got to be understandable. If a company follows these two criteria, content and presentation, they focus on improving these two things, they will have higher quality of earnings. Okay? So, like I mentioned before, there's a little bit of theory, but it can come up. The question that I've seen on a midterm asked is, name and describe the two criteria that make up quality of earnings. Okay? So if you're going to take anything away from this section, just know what the two criteria are for quality of earnings. Okay? And understand how they improve the income statement. All right? If you know that, you're going to be golden. So the third and final section of this first lecture video is just going to be reviewing operating activities and non-operating activities. Okay, now it's important for us to revisit this because it's going to come into play later in the second lecture video. So just to give you like a little bit of a sneak peek as to what we are building up towards, in the second lecture video, I'm going to be going over the various kinds of income statements. And there's two main kinds. You got the single step and you got the multi-step. Okay, now the single step income statement is ones that we are familiar with. The ones that basically it's very similar to what we prepared at the very beginning of this video, right? It looks exactly like this. But the multi-step, however, organizes their information a little bit differently. And what it draws off of is it separates activities based on operating and non-operating, okay? Now, you don't really need to know that right now, but what I want you to know is that it's important to understand what's operating and what's non-operating because it's going to help you succeed in the second lecture video. It's going to help you understand that a lot better, okay? But ignore all that for now. Let's just focus on what is operating and what is a non-operating activity, okay? So what is an operating activity? An operating activity is just, an activity that an organization engages in or participates in on a day-to-day basis. Something that just makes sense for that company to do, right? So, for example, let's take a movie theater, right? If a movie theater sells a movie ticket to a customer, that's an operating activity, right? They sell movie tickets every single day. It's a day-to-day thing, right? And it just makes sense. Movie theater, obviously going to sell movie tickets, right? But let's say the movie theater, right? The movie theater decides to, buy shares of Coca-Cola, right? They decided they had some extra money and they wanted to invest it. So, movie theater buys shares of Coca-Cola. They buy 10,000 shares of Coca-Cola, and then Coca-Cola pays 10 cents per share at the end of the year, thus a dividend. So, at the end of the year, the movie theater holds 10,000 shares. They get 10 cents per share. They get $1,000 worth of dividend revenue. Is that operating? No. That is what you would call a non-operating activity, right? Because it's not like the movie theater is getting dividends every single day. They're not, right? And it just doesn't make sense, you know what I mean? Like, movie theater company gets their sales from movie theaters or from their concession. You don't really think of them as a company that's going to get a lot of dividend revenue. So you would call that a non-operating activity, okay? Now you know the difference between an operating activity and a non-operating activity. Now we can break it down even further, okay? Now what we want to do is look at what is an operating revenue and what is a non-operating revenue. What is an operating expense and what is a non-operating expense. So you're probably wondering, why do we want to look at that? It's because, again, flash forward into the multi-step income statement, right? It likes to separate the revenues between operating and non-operating. And the same thing with their expenses, okay? You don't need to know that right now, but I just want to let you know that's why we're going to be looking at operating and non-operating revenues and expenses, all right? So let's first look at operating revenues. What is an operating revenue? As we know, any type of income that happens day to day for the company. So like I just mentioned with the movie theater, ticket sales, right? Or even concession stand sales. They sell popcorn every day, right? And it makes sense for a movie theater to do that. So it's an operating revenue. A non-operating revenue is, the movie theater gets dividends. They don't get dividends every day, and it doesn't make sense for them to get dividends. So when they receive them, it's a non-operating activity. Now moving on to expenses. What is an operating expense? Again, kind of the same thing as operating revenue, right? Any expense that happens on a day-to-day basis, that just makes sense for the company. So the movie theater. So the movie theater has to supply their concession with, popcorn and, hot dogs and stuff from their suppliers. So when they buy those products from their suppliers, that's an expense. They have to pay for the popcorn. But it happens every single day. So it's an operating expense. Another example of an operating expense is, the rent they pay for their building. Day to day, they're incurring rent, right? Every single day, they're incurring some sort of rent expense on it. They're using that facility every single day, and it just makes sense. Like it's a movie theater. They obviously have to have a space to show the movies, so they have to pay rent for it. So it's an operating expense. A non-operating expense, however, is something that is obscure, unusual, doesn't really happen that often. So let's say, again, going back to the movie theater example, there's a fire overnight and it burns down half of their, supply of popcorn, right? They lose all their popcorn, right? Well, that's obviously going to be an expense, right? It's a loss, right? They have to write off the loss of the popcorn that they lost from the fire. Well, that loss is an expense, but it's not like that thing happens every day, right? It's not like you expect them to have a fire every single night. So obviously it's a non-operating expense. Another example of a non-operating expense is, let's say the movie theater company decided to sell one of their old projectors. Let's say they bought this projector about 5 years ago, right? Bought it 5 years ago for about $1,000, right? So now they're trying to dispose of it, and they end up selling the projector for scraps for about $800, okay? So, when you do the journal entries and everything to record this transaction, what you do is you always write off the projector. So you'd credit the projector for $1,000, and then of course debit your cash for $800. But of course there's that gap in between. What is that gap? Well, it's a loss of $200 from the disposal of the asset, right? It's a loss. It's an expense, right? So that $200 is an expense, but it is non-operating. Why? Because, think about it, right? It's not like the movie theater company is disposing of these projectors every single day, right? It's not something that they do on a day-to-day basis. Therefore, we classify it as non-operating. And, they're not in the business of disposing stuff. Well, I guess it kind of makes a little bit of sense for them to dispose of an old projector, right? It's not what they're in the business for, okay? You expect the company to incur expenses that support them to bring movies and concession goods to their customers, and one of those activities does not involve selling off old equipment, right? It's just not part of their day-to-day operating cycle, right? It's something that they kind of do on the side, which is why we classify it as a non-operating activity. So now, with this foundation and knowledge that you've gotten, not only learning about operating and non-operating activities, but also learning about how to prepare a basic income statement, we can now all take this and move on to the second lecture video, where we're going to start looking at the different kinds of income statements. All right? So I hope to see you there. Hope this video helped you guys out.